Savita Subramanian expecting a bumpy path to nowhere and writing the following. The S&P 500 year-end 23 target 4,000 on 200 EPS. Near-term pain for EPS cuts is likely, but focus on the marathon. We see a potential bottom in the first half. 22 is all about the Fed. 23 is all about the economy. Savita, I'm pleased to say, joins us right now. Savita, is that how you describe it? A bumpy road to nowhere?
Well, I mean, I think the probability of ending the year at exactly 4,000 is low, and point-in-time targets are somewhat ridiculous. But I do think that we are going to go down and then up. The problem is that is an increasingly consensus view. So I think the bigger risk heading into the first half is actually not being invested in equities. I actually think that having a little bit of a cyclical tilt makes sense at this point, because I think the market is looking through the most widely telegraphed recession ever. I think that having some exposure to CapEx plays, to cyclicals in the form of energy, financials, to me makes a lot of sense, because I don't see demand for energy going away, and I don't see supply coming back online aggressively. Financials could benefit from, a kind of a recession. It could do better in a recession because it's a higher quality sector, but could actually benefit from easing credit conditions. I think we need to look at the market differently. We need to look at this recession differently. This is not the typical recession. In fact, a whole section in our year ahead report was dedicated to the idea that this is not your mom and dad's recession. This is going to be different. And the reason it's going to be different is that we've still got inflation. We've got a Fed that is fighting inflation more aggressively than they have needed to in a very long time. None of us in our careers have seen this type of Fed. We've got a consumer that has made a ton of money from asset inflation, especially on the high end. And now the high income group is getting laid off and losing asset value. So I think this recession is going to be different. And I think that's what we need to pay attention to.
Savita, if I clip the first part of those comments, there's no way I'd think you'd have a year-end forecast of 4,000. You sounded almost bullish. Are you de-emphasizing the importance of the index and selectively taking cyclical risk beneath the index and just removing tech from the story?
Absolutely. I mean, one of our themes for the year is don't index, outdex. Kick out the biggest mega cap stocks because they're still in the process of re-rating, and even though they look cheap, we think they're value traps. Buy the rest of the S&P, buy small caps, buy the equal weighted S&P. But I think that not having exposure to stocks and sticking all your money in bonds and cash is a mistake at this point. I mean, a lot of our sentiment indicators are telling us that the world is bearish, and you just heard it from all the other strategists. Be defensive, bunker down, get into healthcare. I think what you want to do right now is think about both the long term and the short term. In the short term, the Fed is probably going to be forced to hike more than we're expecting. I think inflation is going to remain upward sticky because of CapEx trends, because of deglobalization, because of protectionism, because of net zero trends. All of the above contribute to inflation. Plus, the second largest economy in the world is coming back online. Isn't that a little bit inflationary? So I think the idea is think about the long game, but don't sell everything. I don't think this is the time to be out of equities.